Carlos McWhorter, CPA here, and today we're going to do a deep dive into Tesla. We're going to do a fundamental analysis looking at their income statement and balance sheet and cash flow trends to look at how quality of a company is Tesla really. We understand its popularity in the course with Elon Musk. We understand how he has made the company so popular because he himself is very popular. We want to know what we're really investing in when we're looking at Tesla stock. So we're going to take a look at that and also look at the intrinsic value based on the future growth rate of the company. Is this stock price currently where it's at right now actually a good price for this company? So let's take a dive into this. So right now, looking at Tesla over the past 5 years, we see that their stock is up 1,276%. That's amazing growth over the past 5 years. However, we see that they've been pretty flat in this area. You have to turn that on. We see that they've been pretty flat over the past 3 years or so, with a slight downtrend, but pretty much kind of staying on par right now. $210, or after hours, $211, because today is Saturday. $211.50 per share is where it's at currently. So just looking at the past growth, long-term growth is pretty solid, but we see they've been pretty stale in a slight downtrend over the past 3 years or so. Right now, the PE ratio is, I would say, pretty high at 59.19. That's saying for every dollar of earnings, you're paying $59 for that. So is Tesla a quality business at the rate of, or at the point where $59 for $1 of earnings is a great deal? It's all about how fast those earnings are growing. So we're going to take a look at that in a little bit. So just looking at the segments, hopping right into it. Looking at the business segments, 85% of their revenues comes from the automotive sector. Then you have 6% from energy generation and storage, and services and other. So many people say that Tesla is a tech company, focus on tech. So we're going to look at that, look at their ratios and margins to see if they really are a tech company. But just looking at the revenue sources, we can tell you it's an automotive company. 85% of the revenues comes from the automotive sector. Now just look at a few years ago, let's see how much it's changed since then. Let's grab it, drag this over. In 2021, 88% of their revenues came from their auto industry. So as we see, slight increase in the energy and storage in their services and other, but for the most part, they're still primarily an automotive company. So we want to keep that in mind as we go through the numbers, deciding if we like this company or not. So looking at the revenue trends, pretty solid over the past 10 years, of course. We have 36% average growth rate for the past 5 years, 37% for the 10 years. But we have to look at something. Even though we're still in a high growth state technically, because over the past 5 years, they've grown at 36%. Over the past 2 years, or let's say last year and looking at the last 12 months, their margins or their growth rate has dropped significantly. 51% down to 18%. And right now, for half of 23 and half of 24, they're down negative 1.5% for their revenue growth. So high growth, but we see that growth rate is kind of tailing off really quickly right now. So we have to look at that and keep that in mind. Growth rate is pretty solid. However, this could be signifying a real change in the business as far as the automotive industry, because the competition with EVs are intensifying so much. And this is why we're seeing some of those revenues being constrained. There are other areas when it comes to the robo-taxis and the AI and energy storage and even the humanoids, the robots, that's kind of in development stages. It hasn't taken off yet. So their primary revenue source of autos or cars are kind of slowing down. So we see that evidence there. Looking at gross margins. So this is where you can really see what type of business Tesla is, because we say it's a tech company, but tech company has margins of 60, 70, 80%, and sometimes even 90%, depending on the company or the stage of their development. But we see this tech company has 21% margins over the past 5 years. And over the past few years, again, similar to what we're seeing in the revenue constraints. We see a drop in gross margins, 25% down to 18, and for the past 12 months, down to 17. So these are definitely not tech company margins. These are manufacturing margins. So gross margins, 21%. So for a manufacturing company, this is pretty solid. For a tech company, this is pretty horrible. So we want to keep that in mind when we are saying that a company is a tech company. We had to look at the actual financials, and that's going to tell us what the business is. So let's look at net income real quick. So we see from 2014, it had some losses, got into the profitability area in the year of 2020. And we see right now, 13 and 15% for the past few periods, growing at about, or I should say averaging 11.3% margin for the net income. Pretty decent. So for every $100 that they bring in, once they pay for everything, they're holding on to about $13 right now as their net profit margin. So that's where they are there. Cash flows. Let's look at what cash flows are letting us know here. Okay, so similar to the revenues, we see consistent growth, and then we see a tail off right here, or these past 2 years actually. So we see cash flow is decreasing in 23 and the last 12 months. Again, the constraints with the competition in the automotive industry, in the EV industry specifically, is causing this. So we see solid growth, but we see that this growth is not as solid or as high on average as revenues, but we do see a tail off or some decreasing cash flows similar to revenue. So it's on par with that, and we got to keep it in mind. Always got to remember this when we're looking at the growth of the business, because remember, when you're buying a stock, you're buying the future growth of the company. You're never buying the past growth. The past growth kind of lets you know what the company's been through, potentially what they're going to experience in the future, but that's the past growth of the company, and we are buying the future growth when we buy stocks. So this is why these last 2 years with this decrease in revenues and cash flows is very important. So let's go to the balance sheet. How much debt are they holding on their balance sheet compared to the free cash flow, the cash that they bring in that they use to pay off their debt? So right now we see that their debt balance peaked in 2019, but it's coming down. Looks like they, on average, 5 years, about $6 billion, $6.1 billion, compared to an average of $3.8 billion in free cash flow, which means they can pay off their debt on average in 1.6 years. That's a great leverage position to be in. So that's really great for them. Now let's look at, they don't pay a dividend, so shares outstanding. Shares are trending in, well, we would say the wrong direction. We want shares to come down. We want the company to get that cash flow, buy shares, reduce the number of shares, giving more value to the existing shareholders. However, for Tesla, this isn't the most alarming thing. One, I think their stock has been overvalued for a long time. So a company selling shares and increasing the share count, bringing in pretty much free cash makes sense for a company really this young in its development stages. People don't think of Tesla as a very young company, but it still is. And also, the stock was overvalued during this time. So this was a good time to sell shares if you're going to do so. So that's, again, we don't like to see that as shareholders, but we understand that for the position that Tesla is in. Now, looking at the economic value added, what is their cost of capital compared to their returns on capital? We want a positive spread here because we want a company to create value by keeping its doors open. Now we see that Tesla, comparing to the automotive industry, has a much higher return on capital and also a much higher cost of capital. So right now, Tesla is barely in the positive with a 0.45% spread of return over their cost of capital. The car industry this year, not good. On average, these companies are losing value by pretty much existing. Their cost of capital is much higher than what they've earned on their capital. So that's a bad thing for these car companies, but a good thing for Tesla. So Tesla is almost 5% above the average as far as value creation, even though they're barely creating value in this area. So keep that in mind as well. So now let's look at the growth rate of the company. Growth estimates are about 2.7%. Now, Tesla does have some plans for some of their robo-taxis to launch in Europe and in China by the end of the year. However, we know with Tesla, a lot of their plans get pushed. A lot of their announcements, they don't happen at the time that they initially estimate that they're going to happen. So when we talk about Tesla, this company that's, again, developing and innovating so much, we have to kind of take it with a grain of salt when they actually list a launch date, because many times it doesn't happen on those dates. So they're expected to launch some things by the end of this year. We know they're still working on a lot of AI development, and I think that's going to take some time to get going. So as far as their future growth, we see that they don't have a whole lot of growth to happen with their EV sector. They have a great product. However, so does Volkswagen, BMW, and Ford, and everybody else who's putting out affordable EVs versus Tesla. That's why Tesla's dropping their prices, trying to come out with more affordable vehicles. So of course, they're going to exist. They're going to be in the market. They're not going to fail. But as far as them having hyper growth when it comes to electrical vehicles is not likely. So their hyper growth that they've experienced in the past is going to have to come from maybe their energy and storage, which is expected to grow at a solid rate, but it's still a small piece of their business. So we can't account that to be such a significant part or a factor in their potential future growth. So it will be a factor, but I don't think it's going to be a factor as big as people may think it may be, or very soon. So as we see, analysts are saying 2.7% is where they're going to grow for the next 5 years. They grew at 52% for the past 5 years is what they're saying, but earnings are going to grow at about 2.7%. So that's very minimal growth. I estimated 3%, just thinking, okay, some of their launches when it comes to the autonomous driving should happen within the next 5 years and should actually push them past just a small, 2% growth. But when considering that, let's see where we're going to go. Here we go. So at 3% growth rate, this stock is actually worth $67.42 based on my assumptions on their growth and also an increase in capital spend as they are ramping up their AI and trying to push out even new car models right now. So 3% growth, that is going to be at $67.42. So right now they are extremely overvalued based on my estimates. Now, you may say, hey, at this rate, what would Tesla have to grow at for $210 a share to make sense? So let's just play around with this real quick. Even if they were to grow at 40% per year, they would still be undervalued. Still be overvalued. They would only be worth $174. Right now they're trading at $210. What if it was 50%? What if they had that much of a growth rate? So about 50%, that's when we're starting to get to the range of where this $210 makes sense for us to buy at. But again, Tesla is saying that their growth is not going to grow as much as in the future. And analysts are saying it's going to be very minimal growth at about 3% as they have these EV challenges with competition and as they're trying to launch new products. Over the next 5 years, we're saying at 3% growth, $67 is their worth. So be careful with a stock that is valued this high compared to their growth rate. Now, I also want to point out something to you when it comes to Tesla, because I think sometimes it's such a popular company and people have such a positive view of the business. They can't fathom how it can be only worth this much compared to the current price. But one thing I think is very unique about Tesla's business is the CEO, Elon Musk. I think his popularity is one reason why the stock trades where it is, because many people are just flat out fans of him and believe in him so much that they'll buy whatever he puts out versus analyzing the stock. I don't think many people do a discount cash flow or even look at the financial statements. So this is one thing that I think is pretty unique in their financials. Looking at their financials in this section, it says that we are highly dependent on the services of Elon Musk, techno king of Tesla, and our chief executive officer. So a few years ago in 21, he changed his title to techno king. Again, I think Elon Musk is a master marketer. He changed his title to Techno King, and even the CFO has a name of the Master of Coin. It's certain things that he does that keeps pretty much his name in everybody's mouth and the media's attention on him. And he does it in a way where people are just fans of him. And this is why they believe in the stock and they believe in the story that he tells about the company. So sometimes the story of the company and what the company actually is don't align. He says, hey, we are a tech company. If you remember a few years ago, Tesla was a data company. Hey, we're collecting all this data and this is where our money's going to come from. So people invested in it thinking it's a tech company, it's a data company, but in reality, they are a car manufacturer with decent gross margins of about 21% versus this high volume tech company with 80% margins. That's just not where they are. That's not who they are. But again, he can sell that story so well that people believe it and buy at any valuation. So I want y'all to keep that in mind when you're thinking about Tesla and when you're thinking about stock analysis in general. What you think about the business gives you a bias, either positive or negative, for that business. I think Uber is another one where people had great experiences with it, so they believed in this company and they invested in it because of that versus analyzing what the operations are. Other companies the same way, especially Tesla. This is one of the big ones where the value of the stock comes a lot from what people think about the business or the story that they tell themselves and believe versus the actual results of the business. So my goal is for you to actually see the results that they have in any business for that matter and invest based on the actual knowledge of the business and their results versus what media is saying. So if you like this video, please consider liking and subscribing. Let me know in the comments what you think, and I hope to see you in the next video.